Good morning, guys. Hope you guys are good today. So yeah, without wasting any time, as of today, and I would like to start by tackling questions that you guys have, and after the questions, I'll be able to start breaking down the strategy from there. So as usual, what we're going to do is that when you have a question, you're just simply going to unmute yourself and shoot your question to me so that I can be able to answer it now. So let's go. We can start with the first one. Hello?
Hi, Mr. Brian.
Hey, what's up? What's up, Mikey?
Good dog.
I'm good. I'm good.
Good.
So I had a question for divergence.
Okay.
So with the indicator, overbought is at the top, and then oversold is at the bottom, right?
Mm-hmm.
Okay. So with the time frames, does a 4-hour divergence is it stronger than what you'll find on the smaller time frames, or is it the same?
Is it you asking if the 4 hour on a I mean the divergence on a 4 hour is much different than, like, for example, the divergence on a 5 minute or on a smaller time frame?
Yes, and also the strength of it. So if I see divergence on a 4-hour, is it higher probability than if I find divergence on the low time frame?
Sorry. No, definitely not. The reason why I'm saying that, if you can be able to check the full structures everywhere, you see the duplication of the same thing over and over again. So divergence happen if it is something that is happening everywhere on a smaller time frame, the smallest time frame like 1 minute, 5 minutes, and it can also happen on a monthly time frame. There's nothing special about any time frame. It's the same all throughout. So there's no any difference that you can say there's a difference here. There's high probability. A high probability should be in a way that like if there were different factors altogether, like different factors, if there was something that was happening that you can easily spot with your eyes on 4 hour instead of the smaller time frame. So there is the probability is all the same. You just have to be good with spotting it at the right time. And like I've said, it happens everywhere. Divergence, it is everywhere, and it happens every second. There's a divergence happening. So I'm just going to show you an example here. I'm gonna okay. I'm having difficulties here. I don't know why this thing is not. Give me a second. Oh, there we go. All right. So I'm just going to show you what you're talking about to show you that divergence is basically everywhere. I'm on GBP NZD. I want to show you how many divergences you can see. Divergences that touches the overbought and oversold. Look at this. So there won't be such a thing as like there's high probability in this case. There's no high probability in this case, like, because the same thing it is happening the same way on all the time frames. And even if I go to 1 minute, so this is 1 minute time frame. I'm just going to show you that the divergences. Same thing happening literally everywhere. So there's like when you if it is something that happens everywhere, so there's no way we can say there's something special about it because of unless if there was a difference that we could see with our eyes, but really there isn't here. So it is something that is very straightforward.
So the last two that you just did, I see for the buy on the charts, you used divergence for an oversold. Am I correct?
You mean this one or this one?
That one you're on right now.
Okay, yeah, what happened?
So when you're looking for buys in the markets, on divergence, you're looking for oversold in that region.
Correct. The reason why we look at the over, so we look here, meaning when the market goes below 20, because of there's no way you can look for a sell when the market is at the oversold. Because the oversold, it means that it has been oversold, meaning excess, over, like from the word over, you can see overbought, oversold. So you cannot continue adding more when it is over bought or oversold. So you have to take it to the opposite direction. That's why it is a very simple thing that when you get a divergence where the second point is at the oversold, you have to start buying it on the main chart. And when you find overbought in a form of a divergence, you have to sell it. Simple as that. So you have to always tackle the opposite. Yeah.
I understand, sir. Thanks.
All right, cheers.
Just one more question. Sorry. So the same thing with re-entries after the initial positions that I've opened. I'd be looking at divergence.
Hold on for me for a second.
Okay.
Sorry about that, my king. You were saying?
What I was asking was, when it comes to re-entries, we'd also still be looking at divergence. So every time it hits the oversold line, that's when we start adding our buys.
Correct. And like when you add those buys, notice that if each and every time frame have its own divergences, you must choose which one you want to make re-entries on. But what you must also understand is that the lower the time frame you're making re-entries on, the more divergences you'll be able to see. And when there's more divergences, the more re-entries you can be able to make. Then from there, you will know that for a divergence on 4 hour to start, and if you come in for a divergence on 5 minute to start, of course the 5 minute divergence will form very much earlier. Then from there you'll be able to enter in the market way much earlier.
Okay, so I understand.
All right, no problem.
Much appreciated.
Frank, how are you doing?
I'm good. How are you, man?
I'm good. I want to ask you the same question. For example, when you're waiting for 4 hour time frame stochastic, for example, I'm waiting for buy. So yeah, the stochastic is making offer soon around 20. I want to execute my trade, the first trade. So I can execute, for example, if offer sold, the number can execute 21 or immediately when he reached 20 offer sold, or still, or I'm waiting little go up.
All right, so you strictly enter after the breakout. I mean, after the crossing over. And what is a crossing over? It is when the two lines they cross, meaning meaning after these two lines they cross, and before these two lines they cross, the market has to touch. So it must immediately touch this line
and then come back. Is it having that touch and then come back down?
Repeat that.
Is it having that situation when he touching the offer sold, it can be go back.
Okay,
yeah.
You're asking if it can touch here and go down again.
Yeah. Is it having that situation?
So what can happen? Sometimes you find that after it touches and it does that, but it doesn't give you the crossing over. Let me show you an example of that. But you find that it doesn't show the crossing over. Just like in this case. Fine. You will think it is turning here. You will think it is turning. And let's see. I want us to use a horizontal line and check where the market was. There, where it was turning a little bit. So in this case, what was happening is that it was a divergence that you could have spotted, and the dangers of not following the crossing over, you find yourself in a situation thinking that even though it is at the overbought, even though it is at the oversold, and it doesn't cross there, you will think you can buy, but it will still drift down. But if you go into a different time frame, like I'm on, let's say on 5 minute, you will see a totally different situation. You will see something that is quite solid than the previous one. When I mean quite solid, I mean let's go back there. Okay, there we go. So there'll be no drifting in this case. And this line represents where the market was at what? Was at the oversold on 1 minute. Now I'm on 3 minutes. Just don't mind the day. Let me go to 5 minutes because 3 minutes is not usual. All right, 5 minutes. Here's 5 minutes. So what was happening here is by the time we're seeing a buy divergence on 1 minute, 5 minutes at that particular time, the market has just crossed the overbought in order to signal for sell. So we've seen two opposite directions. So in that case, the sell one succeeded continue, and that's why you also saw what? A drift. A drift in what? That's why you saw the continuation on 1 minute. That's why you saw it continuing, drifting down like you said, in terms of continuing down. But if you check 5 minutes, immediately after the crossing, immediately after it touched there and the crossing over happened, it started picking up. So you see that buy, it was signaling that buy, but between where the actual market turned, which is here and there, on 1 minute, we saw it as drifting, meaning it was drifting. Drifting, what I mean about that is that after it formed a divergence, it continued drifting down, which is here. It continued drifting down, meaning it made crossover like a couple of times, like twice here. It crossed first time, after that it crossed the second time. And by the time when this thing was happening, 5 minutes was going on a sell. That's why you saw a drift like that. And there are scenarios where 1 minute is at the overbought, is at the oversold, 5 minutes is at the oversold at the same time. That way, that's when you know that there will be a great momentum. That's when you know you can expect some momentum. When they're at the same levels, different time frames, they're at the same divergence levels at the same time. That's when you will know, okay, something very, very, very quick can come out from there. Let me give you guys an illustration of what I'm actually talking about. So I want to show. Let's start with 5 minutes. So whenever there's high momentum or when the market is moving at a high speed, that's definitely what will happen. So let me show that. Don't see anything here. Don't see anything. Let's go to NASDAQ. Let's check out this one. I don't know if 1 minute will reach there, but let's check it out. 1 minute. Oh, there we go. Okay, there we go. So if you can be able to check this thing out. 1 minute. The market was at the oversold, meaning it was in this box. Can you see that? If you can see that, let's go to 5 minutes. Five minutes was also where? In the oversold at the same time. This is what I will refer as sort of some high probability trade. That's when you know, okay, the market, that's when you can expect actually the market to go to your direction without making any drifting or anything of that sort. When this thing happened, with the example that I've made before this one, two different time frames were showing me that the 1 minute was showing us, okay, it's at the oversold, I mean, we have to buy. And 5 minutes was showing us that we have to sell at that particular time. So they were quite different. But in this case, 1 minute and 5 minutes, they're saying the same beautiful thing. So now in that case, you know that, okay, high probability is where. That's why you see there was a very nice sustainability from there. That's what I definitely know about one time frame in relative to divergences. Does that answer your question, man?
Yeah, more appreciate you, Mr. Brian.
All right, cheers, man. All right. Let's move to the next one then. Like I've said, guys, if you have a question, just shoot your question, no? If you guys don't have any question, I can start
Can we check
breaking. Yeah,
goal now? Can we check goal?
gold. Okay.
I saw something.
Gold. Which time frame?
M5 and M1. I think M5 first.
M5. Okay. So let's check this divergence on M5. Let's check also 1 minute. So check out something. So this is very beautiful. And it also makes sense. So yeah, hey, before this thing leaves us, we are buying. It's a done deal. Because why are we buying? Because there was no even time for what? For the first layer. The market just broke and started piling up. And ish, this thing is leaving us, guys. Let's place a buy on this thing. We are buying this thing. We are buying this thing right now. Let's buy.
The analysis is correct, right?
It is, yeah, it is correct.
All right, got it. Can you draw me how to confirm the divergence? Is it from the M5 or is it from the M1?
Divergence M5, I just drew it right now. So even if you go to M1, you'll probably draw the same thing.
Yeah.
So this way. There was no even time for first layer there. So we are buying that thing, okay. And I wanted to check something. If we go to 1 minute, what's funny about this thing is that it makes sense. It makes sense, guys. So let's execute now. Yeah? I'll also be sending off a signal. Six to six, 456.
So the stop loss should be below M1 breakout or M5.
M5. I will indicate now. So stop loss will be around here. Why we're putting it there? Because it is the endpoint of the thing, of the entire footprint setup. So we want a situation where we'll be able to draw a footprint from there. A footprint from there. Now, if the market decides to come down here, we know it's a failed trade because we can't draw a footprint that is like this. We can only draw this kind of a footprint. So
Okay.
it's a good trade. Okay, this shot up like crazy now.
Do you consider Euro Open, US Open, or volume in this MMC footprint?
Do I consider what?
Do you consider the opening time of Europe Open or US Open?
No. The footprint always follows. The news events, whether it's news events, sessions, they always follow. So the strategy, the way I've designed it or the way I formulated it on how the market moves. And
Okay.
when it is formulated on how the market will fare, the sessions are just there just to fuel up the momentum of wiping out whatever money it is available on the market. Because majority of people lose money. It is not a secret. And when majority of people lose money, when news events come, they check how many people have a certain stop loss at a certain position. They check how many people are buying. Let's say, for example, gold. How many people are buying gold? How many people are selling gold? If majority of people are buying gold, they are going to sell gold hard. So now when these events come, you'll find that that sell becomes very steep because of they're trying to wipe out the people on the opposite direction. So and that number always fluctuates in terms of, there's always a majority of people buying or selling, and that way, that's how the strategy is formulated. So it doesn't get affected by news events. The actual way of how the market moves, it is the footprint. The market is the footprint, because it is not something that you should convince yourself that it is working. You can actually see it with your own eyes, that it makes sense the way you're actually seeing it. It doesn't need a rule. It doesn't need anything. You can see it. You can see the movement with your own eyes everywhere where the market turns, everywhere where there's high momentum. There's no way there wasn't a footprint. Even this long buy, there's no way you could not be able to spot a footprint anyhow. Like this big buy that happened, there's no way. That's what I'm saying. Like it is actually working, and you can see that it is actually. So it's not something that you should spend too much time on it, and because you will confuse yourself, because you can see exactly what is happening, and you can see from where the actual market turned, where there was a sharp turn. It allows you to eat the entire movement from there. Now, if you can observe any other turn that happens, you'll be able to see that everything just makes sense from there. And even if some small retracements like this, the market will show you that that retracement, it is very temporary. Well, how is it going to show you? Let's say after here you enter a sell. And after you enter a sell, I want to show you the footprint that you can be able to draw. You can either draw a footprint there or there. So you will imagine, you will just get amused when even the footprint line gets broken. Even when your footprint line gets broken, you know that, okay, the market is going into the opposite direction. So you have full answers knowing where the market is going, because you have full control. You know that if it is not going my direction, it will go to the opposite direction. How will I be able to detect if it wants to go into the opposite direction? It will either break my footprint, or it will break even the first layer. Then from there, you just have to know what to do from there. Just a matter of spotting divergences and executing in all kinds of ways. It doesn't matter if the market that is choppy, it is consolidating up and down in different pairs. What is 1 minute, whatever time frame. The market is the same. The market is the footprint. The footprint is the market. You just have to be good with spotting it. That's why I prioritize and I tell people, practice as much as you can. You guys see the guys who practiced in a group, especially in group 1, they're going crazy because it's something that it is easy to look at. You can be in a flight and place a trade right now and make $1 million while you land. Simple, because it is something that it is actually happening with the market. Whatever movement that happens in the market, footprint is involved. Simple as that. If you can keep it simple and straightforward like that, you will simplify trading and make more money, because you spend less time trying